This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Lac's picture that says looking for the downloads. Nick, we're recording this just right after the PPI numbers came out. The market obviously turned to the downside a little bit. We had to even refresh our charts a little bit before we recorded this. So let's get to the levels we're watching on this S&P. Did anything change for you here?
Absolutely, Patrick. That was a pretty crazy move after the PPI was released. So right now, as we speak, spot on SPX is about 41.10 or so. Expected move looking at the March OPEX now is about 160 points in either direction, which is about a 3.9% move up or down. So the upper expected move is 42.70. Current resistance right now is 41.20, which was broken previously, but we're not back below that. And next level above that would be 43.25. For the lower expected move, again for the March OPEX, is 39.50, and 4,000 should act as heavy support for now. Beyond that, we have support at 3,800, then 3,700, and then 3,500 acting as lows, back from October or so.
Right. It's interesting for me. We're actually potentially going to start testing some very important lines in the sand in terms of whether the bulls can maintain the trend. My view on the S&P is very simple. The bulls have been in control. It's above its moving averages. It's above any trend lines. It continues to demonstrate a pattern of accumulation. But recently, in the last few days, we tried to rally back up toward the highs and failed to do so. And so maybe it's a little too early to start seeing that the market's getting a little heavy here. We're now going to approach some very critical support levels. To me, 4,100 is the first kind of a little line in the sand, but not the major one. For me, as I drew on the charts here, the levels are much closer to 4,000. That's where 50-day moving average, the ascending trend line, and a Fibonacci retracement of that kind of December to February rally all lie. And that's the kind of point where the bulls will really need to defend the line. If we see even a pullback here, 50 or 100 points, but the bulls buy the dip and rip it right back to the highs, and February is just going to continue to be a very kind of choppy, sideways range-bound market. But where I would almost immediately start having red flags that something more ominous may be underway is if we start getting below 4,000 with any momentum, and that's certainly the levels that I'm watching. But nonetheless, let's move on to the QQQ. Now, we're recording this pre-market. Obviously, it looks like that the Qs are going to open around 305 here on the open here. What's your thinking in terms of these levels?
Yeah, absolutely. After that PPI data was dumped, we had a huge sell-off right there on open pre-market rather. And current spot on Qs is 305. Again, expected move for the March OPEX because tomorrow is the February OPEX is about 16 points, which denotes about 3.2% move up or down. So the upper expected move there is 321 approximately. Keep in mind resistance is at 320, then at 330. The lower expected move is 289. Previous resistance should now act as support at 296 or so. Beyond that, we have support at 260 and then 254, which are the lowest from October again. And keep in mind that this earnings season wasn't that great. However, most of these big tech names responded favorably to their reports, aside from perhaps Amazon and Google. So we may see some more volatility ahead. And
Nick, the interesting thing for me is that there's no doubt that the NASDAQ has shown relative strength in the 2023 year. I mean, we're basically 6 weeks in, and there's no doubt that the NASDAQ blasted off on a relative basis. And we saw massive underperformance in the defensive sectors, whether it was the healthcare, consumer staples, utilities. And so it was clearly a sector rotation of going back to high beta and into the more volatile names. And this trend has been, something that I think is really important to watch, because I think that if the next sell-off was to begin, I feel that that rotation back to defensives will be evident, and we should start seeing the NASDAQ underperforming. And clearly, that's not the case yet. And so that's certainly going to be something in my mind to seeing if this trend of outperformance on the NASDAQ persists, or whether we start to see it diverge. Nonetheless, let's move on to the VIX, because we were again down in towards the 18 handle, and this morning a little bit of a pop back toward 20, but not. We're still in the teens. So volatility continues to narrowly consolidate along major previous support lines, but clearly no sign of a major breakout here. What are you watching?
So yeah, it's been very interesting this year watching the VIX. So spot right now is 19.64 as we speak. Expected daily moves in the broad markets is about 1.23%. Looking at the chart here again, heavy support at around 18. We've seen numerous pop-offs back to the 30, 35 level off these levels. And an interesting observation that I've had over the past year or so is that since we've released 0-day expiration options for every day of the week on SPX, option activity is being suppressed because the volume on the 30-day DTE option activity is much, much lower than it has been historically, which is what the VIX is predicated on. So all these larger intraday moves are occurring without corresponding spikes in the VIX. So, it's very, very interesting to watch that. We're seeing these swings intraday, from red to green, where we swing, 1.5%, 2% from top to bottom. Meanwhile, the VIX is idle or negative for the day, right? So very interesting to see here. But again, February OPEX just concluded, and we're rolling over to the March OPEX now. So it's possible we see a spike here, but it's anyone's guess as to what happens right now. Now, on page 5, we have the U.S. dollar, which has started to turn around as all signs point to further Fed rate hikes, as well as rates remaining higher for longer. We had higher PPI than expected, higher CPI than expected. Retail sales were much stronger than expected, and the non-farm payroll numbers came in much higher than expected as well. So this is all ammunition for the Fed to keep on going higher for longer. Eric, what are your thoughts here on the dollar?
Same story as last week. We're still hugging 104 resistance. 104 was a very important level. It was the top about 5 years ago in that first big wave up. Then on the way up to that recent high, it was a resistance level, and then it was a support level on the way down. Now it's resistance again on the way up. So I'm watching 104 closely. A breakout above 104 or a firm rejection down from 104 is going to be the tell for the next leg. Ever since last week, show, we've just been hovering just below 104. Looks like we're trying to break through that level, but it hasn't happened yet.
Well, for me, Eric, the dollar has obviously started to strengthen in the last 2 weeks, crawling a little bit higher. You're bang on. This 104 level is really, really important. Obviously, the U.S. dollar yen has already started to break out and followed through. This really is all about the euro finding support along the 107 level. It's going to be really important in my mind, because this dollar strength has corresponded to some gold weakness and all sorts of other types of intermarket relationships. And if the dollar, for whatever reason, broke out with some momentum and really started to advance on a relative basis, it's going to act like a wet blanket over all risk assets. And therefore, watching what the next major move in the dollar is just going to be critical.
Since you mentioned gold, let's move on to page 6, where we have the chart of the gold futures. Now, what's your thinking here?
Well, I said 2 weeks ago on MacroVoices that I was eyeing the 38.2% fib retracement to add to my longs, and sure enough, I just got filled on my first tranche at 1841. Then we saw a nice dead cat bounce all the way up to 1855 on Wednesday evening, but as soon as Europe opened on Thursday morning, that retraced back down, looking at 1845 as I'm recording now. I won't be surprised if we do go lower than 1845 1638, which is the 38.2 fib retracement. I think the scenario for this to be over here, for this to be the bottom of this gold correction, would only be if we were to see a rejection on the dollar index. In other words, it rejects 104 and moves sharply lower and resumes a downtrend. Absent that, I won't be surprised if we do see lower numbers. The technical levels to watch from here are going to be 1796, that's 1796. That's the 50% fib retracement. Then the next level below that is 1783, actually 1784, which is the 100-day moving average. And then finally 1753, 1753 is the 61.8% fib retracement. So those are technical levels to watch. I don't know where this correction is going to bottom. I do think it's a correction. It's probably going to be the dollar index that decides where the next leg comes.
Yeah, Eric, to me, the gold is just demonstrate, like it reversed literally the same day that the dollar reversed off the bottom. I know a lot of people are looking at real rates and they're looking at all sorts of different elements, and it's not that those aren't relevant, but really what has stood out over the last year was the inverse correlation of gold to the dollar. It's really just been a cross currency, and I don't see any reason to deviate from that until we see some evidence that gold is marching to the beat of its own drum. Right now, if 104 level holds on the dollar and we see dollar weakness resume, this could be a short-term low on gold. But if we see the dollar index ripping at 106, 107, 108, I don't see any reason why gold can't consolidate towards 1800 or even 1750 on the downside. I obviously have a bullish tilt over the much longer term on gold, but I think in this phase where the Fed is still tightening and we are moving toward a recession and risk assets may be, still have turbulent waters ahead of it, I still think that gold is going to have a couple of fake outs both on the upside and the downside. It's going to be a little bit choppy here on the short term. Moving on, I just want to lastly touch on the crude oil chart. I know, Eric, I know you were talking about it in the start of the show. And for me, one thing that's been evident and continues to be evident over the last 9 months is that crude oil has been in a substantial mean reverting distribution cycle. Lower highs, lower lows. Every rally is failing. But really what we have seen in the since the start of this year is that even though we've seen crude oil weakness, it's clearly finding supports. It seems to have now found that lower bottom range in the low 70s. And in order for crude oil to truly neutralize this 9-month down cycle, I think we need a proper advance up into the mid-80s. That will certainly trigger a number of trend following techniques to start flashing green. You're going to have a number of technicians identifying a breakout, and that may be enough to shift the order flow to potentially give the bulls a shot. That is clearly not the case here below 80. And so I think it's really critical to watch if the most imminent move on the upside could get started here. And that's certainly something to watch into next week.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.